So we got an interesting topic today, audits and how to avoid them, and did some interesting digging around. Fortunately, one of the hard things about trying to find audit statistics is CRA is not too apt to publish a lot of details, and what information is out there is a little bit old, but was able to find some statistics that help us identify roughly how many audits go on each year. The data is from 2012, so how accurate that still is, it's hard to say. But it was interesting nonetheless to realize the total number of audits and the breakout of where these audits tend to take place. General audits for small businesses happen at less than 4%. So it's a small percentage of the population that are actually being audited. But interestingly enough, we've got almost double that amount in GST, HST audits, which seems to be the highest probability of an audit, of any type of audit, whether that's personal, corporate, GST, HST, or any of the above. So that's interesting to note, and definitely jives with what we've seen over the course of the years, is that well, they're usually pretty straightforward, particularly for our client base, who are mostly on the GST, HST quick method, which is the best form for independent contractors. It does still seem to be the highest area of focus by CRA. And it's also the area that they have a tendency to lock down and freeze accounts on, which is never fun. Apologize for the ringing in the background here.
Okay. So what do you think are some of the key areas for a CRA audit trigger?
Well, I think there's a number of areas that they've looked at, things that identify or cause unnecessary attention. Probably the most notable of which is discrepancies between different forms, or what they call slip matching. If there's ever a discrepancy between the amount that's on the T4 versus the amount that's reported on the T1 or the personal tax return, you can pretty much be guaranteed that there will be an audit. So that's sort of the number one probability. There's a really interesting, sorry about that, interesting blog where I gathered some of my statistics from a tax law firm, and that's the one where they told me about 80,000 GST, HST audits are in a year. And there's another great one from Gowans, who was actually who we worked with through the NACCB to represent the PSB audits. And they identified sort of the top 10 areas that cause audits. And first and foremost is inconsistencies between third-party information and taxpayers' filing position, which is exactly what I was talking about earlier, is this concept of slip matching, where if there's information that's on one slip or one form that's different from another, you can be guaranteed that there'll be an audit that will come as a result of that.
And so, Andrew, just for from an incorporated consultant point, that's obviously not an audit point on the T4 matching, but for proprietor, if you're going through a staffing agency, you would have a T4A. But as an incorporator, is there an incorporated entity from that slip matching? Is there something there that they should be watchful of?
Yeah, absolutely. I mean, I think that it's actually probably more common in the incorporated entities than the sole props, because with the incorporated entity, it's usually yourself that's preparing the T4 or the T5 if you're doing dividends. And if you make a mistake in the preparation of that T4 and transcribe a number incorrectly, or just put the information wrong. I mean, one of the most common ones we've seen time and time again is when people do their own T5s, which is the slip that you prepare when you have a dividend, is whether you mark the dividends as eligible or non-eligible. And when you're a small business entity, they're non-eligible dividends. And it's quite a common mistake that will pretty much guarantee an audit. Of course, putting the wrong source deduction amount or an amount that doesn't make sense as it relates to maybe CDP contributions is again something that we see time and time again. It's one of those areas where people try and save a few bucks by doing it themselves, and often get themselves into a fair bit of hot water and trouble that is completely avoidable if the information had been accurate and correct from day one.
Well, you go back through your continue on your list that you have from Gal.
Yeah, so employer compliance is number 2. So basically being late. If you're late in source deduction remittances, you're late in GST filings, you're late in corporate tax filings, this is again another possibility for generating attention. That's quite common. Not complying with requests for information. So if you get a demand to file and you don't respond, that's going to guarantee that you trigger an audit. What we always say is, it's really sometimes overwhelming when those brown envelopes show up in the mail and you're behind and overwhelmed. And sometimes people just sort of put them in the corner and sort of take the ostrich approach and hope that the problems will go away. And that never solves any of your problems. So the first thing to do is respond, even if you don't know when you'll be able to get the information together, just letting them know that you've received their demand to file and that you are working on it and you're working with someone, hopefully a professional, to help you get everything caught up, and work with them to extend the deadline. Normally they're very flexible. The deadlines that they typically supply on a demand to file are usually fairly short, but once you call them and say, hey, I've received this, I'm working on it, can I get an extension? They're happy to do that. And again, like I say, not replying to any of these demand to file are going to guarantee that you're getting unnecessary attention. Of course, the other thing that they had is any amendments. If you're filing an amendment on corporate tax return, personal tax return, GST return, T4, T5, as soon as you file an amendment, that's going to basically guarantee that an individual is going to look at it. And there's a higher probability of an audit coming out of that. What else do we have? Unusual or notable changes in deductions or credits. So when you have big swings, this can cause unnecessary attention. What I can tell you is that CRA does have a computerized system that we've seen referenced in documentation before. They never tell us how the algorithms work, but they're looking statistically at information to see if numbers make sense. And what I can tell you is, as much as large swings will attract attention, so will no swings. There are basic trends that we expect to see in small businesses. Some categories might happen to stay the same, but usually there should be some ebbs and flows, ups and downs. But if they fall too far outside of the norm, that could trigger attention for you. And again, what we say here is that doesn't mean that you shouldn't take deductions that are outside of the norm, or claim any expenses that you're afraid might trigger attention. You should just be prepared and be aware that if you're swinging outside of your own historic trends, that you should have your information documented and be prepared to respond to CRA in case they come knocking. And generally speaking, just to understand as well, the process in an audit is typically an individual will request some information, and if you can answer that information, that is the end of the audit or the questions that they might have. But if you're unable to answer their questions, they're going to continue to dig deeper. So you really want to be prepared to answer anything that might seem unusual. And again, with an audit, they're not necessarily going to dig into every single line. They're going to be looking for trends that are outside of the norm, not only with you and your history, but also as you compare to averages within your industry and standard industry codes. And one thing that was really interesting is in the Gowling's blog, they even talked about one of the categories they said was if you had reported income that was low compared to people in your neighborhood. So these are other things that are triggers for audits. And the number one thing that CRA is really looking for is unreported revenue, which is typically not an issue we find in the consulting industry. But it is an area that does sometimes come up and that we've seen identified when it comes to reimbursable expenses. And there's sort of two ways of how you process your reimbursable expenses. Some people will opt to not include the revenue or the reimbursement that they're receiving and not record the expense or the outflow of money that they have. And in our opinion, that's a big mistake. You don't want to do that. You should be reporting the revenue that you're receiving as income and the expenses as offsetting expense. The net to your organization is no taxable increase because you have revenue that's directly offset by an expense, so there's no net impact. But you've got the reporting there, and you've got the trail to be able to show, okay, look, money came in, and it was offset by expense. Because we have seen situations where people have come in and the auditor said, well, what's this money coming in from? They're like, oh, well, that was a reimbursed expense. Well, show me the receipts. I don't have those receipts anymore, or I gave them to my end client and I no longer have them. Well, you're going to get taxed on that income now. They're going to charge you some interest.
So so you're saying you gave the original receipts away, so you should be keeping copies of all your expense invoices and all the supporting documentation, even though they were reimbursed by the client for flights, for travel, or whatever those expenses might be. You should keep the copy so that you have that for audit purposes.
Absolutely. And I think the number one thing for defending against an audit is documentation. Now, hopefully you'll never be asked for all of that documentation. Again, sort of the typical process is they'll go in, an auditor will look at your financial information. He will pinpoint a couple of accounts where he'll ask for more information. You'll then supply supporting information, usually in the form of a spreadsheet or a ledger that provides the line item detail that makes up that account. And then out of those items, they'll want to ask you questions about a few specific items and want receipts for those individual items. They won't necessarily want receipts for every single transaction, and they definitely won't be happy if you hand over a shoebox and say, find it yourself. You definitely want to treat auditors with respect and courtesy, and you want to make sure that your information, it's easy to locate and find the information that they want. That's why I'm such a big proponent of all this cloud-based technology that we have now. Using third-party apps like QuickBooks Online and HubDoc, there's ways to be able to link the images or the scanned receipts back down to the individual transactions. So if you ever need to know what a transaction is for or have the supporting documentation, it's literally a couple clicks away.
Okay, that's great.
Yeah.
So continue on with your list.
Yeah, so I guess what else do we have on here? We've got unusual or notable changes in deductions or credits, which we talked about. Participating in aggressive or high-risk tax strategies. So there's been a couple of areas where they've looked at certain types of tax shelters and areas that have gone through scrutiny, and then as a result of those tax shelters being involved with those types of tax shelters, individuals have been audited. Really, that's more related to sort of the personal tax returns, but it is something to keep aware of. If you are going to be participating in these areas that are atypical, high risk, high reward, doesn't mean you shouldn't do it, but you should be prepared, sort of hope for the best and plan for the worst. And it's all going to come back to documentation, and be prepared to defend every piece of information that you file with the government. As I mentioned, the other one that was unusual to me is that, or I was surprised by, is reported income low compared to residents in the same neighborhood. Personally, haven't come across this, but I think it's interesting that Gowling's identified this as an area, because it's particularly interesting for independent contractors, where usually our strategy is to keep your income as low as possible and keep as much money retained inside the corporation. And again, interestingly enough, we have yet to encounter that as a scenario for our clients. So again, our strategy is keeping your income as low as possible. But I guess maybe we're looking at high extremes to that end. And while we keep incomes low, they're still usually at or above the lowest tax bracket, simply because while we want to keep your income low, we never want to go below the lowest tax bracket, as we don't want to miss out on opportunities to make use of basic personal exemptions and low tax brackets. And to take it a bit of an aside here, when it comes to tax planning, even if you're not spending any of the money you pull from your corporation, in most circumstances, we're going to want to give you a salary and or a dividend that at least takes you up to the bottom end of the lowest tax brackets, which is in the $40,000 range. And that's just simply because if a year goes by and you take absolutely no income, you've lost the benefit of taking money out at that low tax bracket. And eventually, unless you happen to have a money tree growing in your backyard, you're going to need to pull money from some source. So you usually want to make sure you're making use of all of the periods that you have access to and using up the basic personal exemptions and low tax brackets in all of those periods. Now, this is again when I don't think applies too much to the independent contracting market, although we do see more and more clients who've been contractors for years, who've built up net worth, investing in physical real estate. And one of the areas that they have noted is that if you have reported income, or sorry, not reported income, if you're not using the fair market value for residential real estate rentals. So that's, again, not a huge percentage of the consulting market that affects, but as people become or have built up more net worth and retained earnings, we're looking for ways to invest that and use that money. And certainly there's definitely a large group of people who like physical real estate, and how you track and manage the reporting on the physical real estate investments is something that is important, and if not done correctly, can garner unnecessary attention. And the last one, which is I think a really important one, is referrals. There's been a push by CRA to encourage people to report on their friends, on their colleagues, on their neighbors, if they think that they're doing anything unethical or fraudulent or evading tax in any way, shape, or form. So one of the things that you want to be careful of is how much information you're divulging to your coworkers, to your neighbors. And of course, you never want to do anything fraudulent or misleading, but you also want to make sure that in your communications with individuals that you're not giving the impression that you're getting away with anything, which I think sometimes is part of the problem that we have in the independent contracting market. Is sometimes people think that because of the tax advantages that we have for small businesses, that they're getting away with something that is sketchy or not ethical, or that they're not entitled to it. And absolutely, as an independent contractor, you are absolutely entitled to the benefits that you have of a small business entity. And there's a reason that the government has created incentives to help small businesses. And we're very lucky here in Canada, and specifically here in Ontario, with the benefits that we do get for the small business tax rates and the ability to deduct expenses. But there's a reason that we've done that, and there's a reason that our economy has done so well by supporting small businesses, because small businesses make up the majority of the wealth here in Canada, and actually provide the majority of jobs, believe it or not, compared to large organizations that are obviously, there's a much smaller number of total large organizations that do employ individually large numbers of people, but compared to the amount of people that are employed by small businesses, it's still just a fraction. So I think that's really interesting. And so be careful what you say and how you say it. And again, getting back to some of these statistics, where we've got, sorry.
If a business is facing, go ahead.
No, go ahead.
I was just saying, if a business is facing an audit, like what are the steps that they should do, like at that point? Like, should they do something now proactively? Should they? Like, what do? You get a letter in the mail from the CRA saying you're involved in an audit.
So,
like, should I risk myself? Should I reach out to a professional? What should I be doing?
Always reach out to a professional. Hopefully you're already working with an accountant who's knowledgeable and experienced in the industry. And what we do with our clients is we always tell them not to deal with CRA unless there's absolutely no option. So the response, you definitely want to reply and respond and make sure that you're aware that, yes, I'm working on it. Yes, I've received your information. Here's the contact information for my accountant, who has all the information available to provide you, and will be responding on my behalf. Obviously, in order to do that, we need to have authorization to deal with CRA. So that's something that should be done well before you ever have an audit. And it's something that we do with every one of our clients. Basically, the minute you become retained, the very first thing we do is get authorization to deal with CRA on your behalf. There's a number of reasons that we want to do that well before we ever get to an audit scenario. Just being able to have access to your online information, be able to confirm numbers, what CRA has with our records, so that we don't get into that situation that we talked about before, where we have discrepancies between what's in their records and what's in our records, or what we're going to file. But once you get that notice, you want to make that introduction to your accountant and have your accountant take over the role, because it's really easy to put your foot in your mouth and say something inadvertently that you don't mean to. I've seen it time and time again when it comes to payroll audits. Payroll audits, again, are fairly common in our industry, and I would say higher percentage in this industry than other industries. So if you look at payroll audits as a percentage, on some of the statistics, it's going to be lower than GST, lower than a general audit, but in our industry, it's going to be a higher percentage because many owners of their businesses will take their salary once a year as opposed to monthly. And pretty much the minute you pay a payroll source deduction and don't have one the next month, that's going to trigger a standard letter that comes out from CRA, and how you respond to that letter will determine whether you get audited or not. And it's really easy to respond incorrectly and use language and literature that can get you into trouble. Whereas if your accountant responds, he knows exactly what to say and what to do, that will put that issue to bed. So make sure
does it make sense, like if you are collecting payroll, like then avoid those types of audits, to like take payroll monthly or quarterly versus once a year? Are they?
Well, there's pros and cons of doing payroll monthly versus annually. Monthly obviously is going to trigger less attention by CRA. There's going to be some advantages with it. One, obviously, you're going to have to pay your payroll sooner. Two, you're also going to have to pay and file every single month, which means more work by you individually and or your accountant. And if it's your accountant, that's usually going to mean higher fees. In addition, because you are trying to be preemptive and doing the planning at the beginning of the year rather than reactive and looking at what's taken place over the past year, there's a higher probability that you'll take more income than is necessary. And again, with the small business, the strategy is to leave as much money inside the corporation as we possibly can. So being armed with all the information and being able to make the decision at the end of the year gives us some benefits in the planning phase. but it really comes down to your risk tolerance and where you're comfortable. And that's, I think, one of the big things that we do here is we offer what we call full option accounting. And what a lot of people don't realize is that accounting is not a black and white game. There's a lot of areas that are really gray and open to interpretation. And you can be as aggressive or conservative as you want to be, but it's important to know and understand what is aggressive, what is conservative, and to make an educated decision on where you want to fall on that spectrum. Because, you know, for some people, it's going to be worth the extra headache and hassle of filing their payroll on a monthly basis to know that it's less attention from CRA and going to avoid any potential payroll audits. But for other people, they might be more concerned with having access to the time value of money and being able to make sure that they're keeping their total remuneration to themselves as low as they possibly can. And again, typically, if you're doing your remuneration in the form of a dividend, again, because there's no payroll remittance throughout the year, you're typically going to do that only once a year. So there are other ways to continue to do your remuneration annually and still avoid those risks.
Okay. And if someone's going through an audit, like, do they have rights as an individual? Is there something that they should be doing?
You have rights and you also have responsibilities. And it's important to know and understand what those rights are. And again, a good accountant is going to help you understand what those are. But the number one thing that I think is the most important thing to know and understand is that you have 3 levels of appeals within CRA. So a lot of people will be audited or issued a notice of assessment or reassessment and just accept it. But the reality is that you have 3 levels of appeals within CRA before it even ever goes to tax court. And even if you are unhappy with the appeals process, you have the option of taking it to tax court and then a federal court of appeals, and if necessary, even the Supreme Court of Canada. So there's lots of options and lots of rights available to individuals in Canada, and it's important to know and understand what those are. And the way to find out what those are, the best solution is to work with a knowledgeable professional who will be there to hold your hand, walk you through the process, and make sure that you're getting everything that you're entitled to.
Are generally the audits, Andrew, are they targeted at like one specific line in your return? So it's like focusing on like your meals and entertainment or your travel, like is there or like your mileage on your cars, or usually one thing they're targeting? They're not going to come out for your entire expenses, or is that?
Yeah, so as I was saying earlier, they're definitely going to pinpoint a couple of areas. They're going to do a high level analysis on your financial statements to pinpoint areas that they think they want to dig in deeper. And that might be different from every individual. There are certain categories that tend to get more attention than others. Pretty much any category where there's a percentage of use calculation, home office, automobile, meals and entertainment are areas that tend to be looked at because there's a high probability of there being personal items in there. Those will often be looked at, as well as travel is another area that often gets looked at. And again, it doesn't mean that you have to be excessively conservative in these areas. You just have to be prepared if you're going to be above average to defend that position. And it's also important to know well before CRA comes knocking at your door whether you are being aggressive or not. So one of the things, again, we do for each one of our clients is we'll do a benchmarking analysis to show you how you compare to the average and the median in our database. And we've dealt with thousands, if not tens of thousands of independent contractors over the last 30 years. And we track all of them using the same chart of accounts so that we can do a strategic analysis to compare the average and the median. And that helps us pinpoint these areas where people are potentially going to be red flagged by CRA. So we have that information well before anything's going to be triggered by CRA, and we can make that decision with the client. You know, do you want to continue being above average, or do we want to knock down these expenses? And okay, if we're going to opt to be above the average, let's make sure that if someone comes knocking, we've got the documentation in place to be able to answer their questions quickly and easily.
Okay. Now, if someone's prepared their own tax return and they get an audit, what should they do at that point? Because at that point, they didn't have a professional parent. Potentially, they made some, they took some advantages of something that maybe they shouldn't have. So now, what should they be doing?
They need to reach out immediately to a professional. You should never go through an audit process without having a professional there to hold your hand. I've seen it time and time again. People, being penny wise and pound foolish, as the expression goes, and they'll file their own tax return, make mistakes, and get themselves in hot water. And how you deal with that is as important as the individual issue itself. So making sure that you work with a knowledgeable professional, even if you didn't have a professional to prepare that information, it still helps to have that professional dealing with CRA on your behalf. There just really seems to be a different level of camaraderie between an accountant and an auditor than it does an end client and an auditor. I think it's also important to know that most auditors are actually usually fairly junior level people, and particularly at the initial audit phases, have been told that when they're not sure how to deal with something, to issue a reassessment and to deny the deduction. As you go up through the appeals process, you are dealing usually with more and more seasoned and experienced professionals. So it's not uncommon for the first person who's going to do an audit on your case to be someone who's fairly fresh out of school.
Okay, great. Is there anything else, Andrew, that you think you could give as a tip or a trick to make yourself a little bit more audit proof?
Yeah, I think the number one tip is coming back to the level of documentation that you're going to be preparing. The best thing in the world that I think every small business owner has in their pocket today is their cell phone, and a great way to have a picture of your receipt digital document. One thing that we've seen time and time again is that receipts fade over time if they can even be found. So even if you're not going to use a cloud-based solution like HubDoc, Receipt Bank, QuickBooks Online, Xero, any of these tools, if all you did was take a picture of your receipt and store it on your computer, you can come back to that at another time, and you know that you've got a digital document that's not going to fade with time. It's still going to be legible, but still going to be reproducible. As opposed to something that's filed in a box, you can't find that box, you don't know where it is, and once you find that box, trying to dig through it and locate the individual receipts can be a nightmare. Whereas now, the technology that we have in place today, if you have a digital document, it can be OCR'd and then put into a system and searched so that you can locate transactions, by vendor name, by date, by amount, so that you can go through these audit processes far easier than you've ever had to before. And what I would even probably justify is back scanning receipts that you've had. You need to keep a minimum of 3 years from the notice of assessment, and we recommend 7 years from the date of notice of assessment. One thing, again, that's interesting to note is that after 3 years of your notice of assessment, then that information becomes what's called statute barred, which means they can only go back and reassess that information if they can prove fraud. So typically after 3 years, 3 years after you receive your notice of assessment, if you haven't been audited on that information, it's going to be safe.
Okay, great. Well, Andrew, once again, I thank you for your time. I really appreciate it, and I think everyone else here appreciates your expertise in this area.
Well, glad we could participate, and if anyone has any questions, feel free to reach out. And again, I apologize for the phone in the background here.
No problem. Thanks so much, Andrew. Okay, thanks everyone for joining. All right, bye-bye.
Okay, bye for now.